welcome to the PRT pod. On this episode, we're going to be discussing illiquid solutions and buyout. I'm joined here today with Origination and Execution Director Jon Loach, LGRI's Head of Strategy Summit Mehta, and LGIM's Head of Endgame Solutions Matt Webb. Before we get into the questions, I'll invite our guests to introduce themselves. Matt, would you like to go first?
Thank you. So Matthew Webb, LGIM Solutions Group. I'm Head of Endgame Solutions, and my role is to help our pension clients get to an endgame of run-off, buyout, or both.
Thanks. Summit?
Thank you, Roshi. As Head of Strategy for LGRI, my role is to look at our internal capabilities and our external proposition and how do we develop that strategically so that we can capture the opportunity in the bulk annuities market. Prior to my current role, I spent about 6 years as Head of Investment Solutions, where I led investment strategy on some of the biggest buyout transactions in the UK.
Thanks. And Jon?
Thank you, Roshni. Jon Loach. In a previous life, I helped lead the client team in LGIM, working with some of LGIM's largest DB clients. But more recently, I've moved across into the PRT business, so still helping many of the same clients, but with buy-ins and buyouts.
Great, thanks. And thank you all for being here. We'll get straight into it, and I'll start with the first question. Can you tell us about the challenges schemes are having with illiquid assets? Matt, would you like to kick off?
Well, it's due to the improvement in funding levels. As was reported by the pensions regulator in the annual funding statement a few weeks ago, more than 50% of pension schemes in the current funding environment are better than buyout funded. But they've got there quicker than they were expecting, and they're still holding a liquid asset, which were useful and part of the growth portfolios that have got them to the position they're in, but are by their definition illiquid, and that can pose challenges for executing a buyout.
Great, thanks. And Jon?
Yeah, I think as Matt says, many of these investments have been very successful, hence the clients are discussing buy-ins and buyouts. We recently did a survey of some of the larger schemes, and they did cite this as one of the key barriers to execution, and it certainly comes up a lot in our discussions with clients in preparation and also in the current pipeline.
Great. And I guess insurers do sort of hold portfolios of illiquid assets such as property or private credit. So what are the main challenges from an insurer perspective? Sumit, would you like to share your thoughts?
Yeah, sure. Taking a step back, it's a great thing, isn't it? Pension schemes have illiquid assets and they're going to buy out, and insurers are always on the lookout for assets, and it should be a happy marriage. The slight kink there is that the assets, some of these assets can sometimes not be appropriate for insurers with respect to their long-term portfolios, either because of the regulatory framework that insurers have to operate within or because of risk appetite. And that's what sort of creates a very important consideration when you're considering illiquid assets within a buyout or a de-risking deal. The way we like to think about it is sort of there are two aspects of this. One is the long term. What is the right long-term home for these assets? Is it the insurer? Is it other investors in the market? And finding a long-term home at the right price is quite important to make the overall affordability of the scheme work. But there's also a transitional shorter-term consideration, which is while you're finding the right long-term solutions for these assets, how do we enable the wider transaction to happen in the meantime, in terms of timing, secondly, in terms of funding as well. How do you fund these wider transactions while these assets are being appropriately transitioned? And it's this combination of longer term considerations and shorter term considerations, which is what insurers like ourselves are really looking at in terms of providing solutions for schemes in this important area.
And I guess in the last few years, we've worked closely with schemes to get to these solutions. What solutions do L&G offer schemes with illiquid assets?
Yeah, and again, sort of going back to that sort of long-term, short-term element, from a longer-term perspective, the best solution would be, can we take as many of these assets into our portfolios? And that's where we've done a fair bit of thinking in terms of our internal capabilities, our risk appetite, our expertise in being able to do that. Now, obviously, some of these asset classes we do hold within our portfolio, such as infrastructure, debt, property, private credit, some parts of private credit. So ensuring we're able to do that at scale is an important area we have looked at. Where the more efficient solution for the scheme and the trustees is finding other longer-term investors. There we've looked at partnering with external investors, investors with different risk appetite, with a different regulatory framework, who are better holders of these in the long term. And there we're working with ensuring that we can provide, we can help sort of be the enabler of that transition from the scheme's balance sheet to those investors. And then looking at the shorter term considerations, we've looked at ensuring we've got solutions around providing price certainty around these, because when you're in the middle of a transaction, these assets, we don't want to have distressed sales of these assets. They're great assets, they're good assets. So ensuring that while that orderly process is going on, we're able to provide the schemes the right price certainty for the transaction, alongside then the funding element. So either by providing deferred premium solutions, where we provide the funding, or working with external investors such as banks or other capital market players to provide that appropriate solution. So these are the areas where we've looked at in terms of being able to help clients. And ultimately, however, when we reflect upon this, ultimately it comes down to what are the client objectives, and on a very sort of binary level, is it certainty or is it value? And so what we collectively do in working together is trying to establish that up front with the schemes we work with, so that we're able to appropriately combine these solutions and these capabilities for the best outcomes for the schemes.
So, Sumit, you mentioned that we look at infrastructure, private credit, property. Are there any constraints around the assets?
Yeah, I think it's not just the asset class which is relevant in terms of the ability and the fit with the insurer's sort of long-term allocations. It's also the structure in the way these assets are held. And that manifests itself in a couple of ways. Firstly, from a regulatory framework perspective, it matters. For example, when these funds are in pooled fund format, then they don't sort of meet the cash flow matching regulations that we have, and that can be quite punitive from a capital perspective. But it's also relevant from an ability of an insurer to be an eligible investor, so that there can be constraints on insurers from being able to invest in certain funds. And so, yeah, that's quite an important element, that structure of how these assets are held.
Sounds like we've got a range of solutions, and a lot of it is just aligning our objectives with the scheme and also, on the insurer side. I mentioned earlier that there are a range of clients we've worked with and a range of schemes where we've been able to provide these solutions. Jon, I know you worked closely on the Boots pension scheme late last year. Could you tell us a bit more about the features of this transaction?
Sure. I mean, I think the background to the Boots transaction probably started over 20 years ago when we were working with this client on various initiatives. So it was our first client for LDI. We set up, I think, our first independent sort of private credit portfolio. We also worked with elements of their, I think it was the DC scheme for an equity multi-factor fund. So we had a history of discussing the art of the possible and trying to understand what they wanted to achieve for their members. When it became clear that a transaction was coming to market, we were also able to speak to the corporate to understand their objectives and, importantly, their time frame. And I think that's probably the key part of the transaction, in that they wanted to do a deal in 2023. However, they had a portfolio of infrastructure, private credit and property that they needed to transfer or dispose of in short order.
And it's that certainty, isn't it,
Yeah.
Jon, that was really important for them, and both certainty of price, but also certainty of timing. And as you say, I think what we were able to do was to combine our capabilities across insurance and asset management and the solutions that we spoke about earlier to provide that certainty of timing and price. And the way we did that was sort of a four-pronged approach, and we looked at their liquid assets. We spent a lot of time upfront due diligencing them, understanding their market parameters, and understanding sort of risk appetite, but also the legal elements of that. And all of that upfront due diligence work in conjunction with the scheme's advisors allowed us to do four things. The first was maximize the amount of assets that we could hold long-term within the portfolio that we could just take in specie. And that was obviously a frictionless transaction for the scheme. Secondly, for those assets which we didn't feel were the most efficient to be held by us long-term, we worked with the scheme and across asset management and the insurance elements, we worked to provide a solution where we're able to enable the scheme to transition them to the secondary market. The third element was via deferred premium structure, we were then able to enable the transaction to happen while this was going on in the background. And the final bit was to enable that we mitigated the tail risk for the scheme because the secondary process, obviously is not guaranteed. We also provided a backstop that if the scheme weren't able to sell them in a designated time frame, we're able to sort of provide that backstop in terms of price and timing. So those were the ways in which we were able to achieve that outcome.
I think there was a point, wasn't there, as we were going through the solution that we've cracked it. We've got something for every single point on the little sort of multifaceted kind of Rubik's cube that we got there.
Absolutely, and I think we did because we have that unique asset management capability when combined with the insurance element. I think that's quite unique to us relative to our competitors, and I think that made the difference in this transaction.
Sumit, you mentioned on this asset relationship, I guess this is where the Elgin relationship comes into play, and I know we've discussed this before on the Power of Partnerships podcast that we did last year. Yeah. Do you have anything to add on the Boots transaction and where Elgin was involved?
Well, the starting point, as we've said, is that Elgin managed the money for Boots pension scheme and also obviously manages money for Legal and General. So the assets, the private credit assets that the scheme was already holding, was an easy transfer from one account to another client account internally to achieve that. Then the wider portfolio and the liquidation and disposal of those other assets, then the challenge was partly in the planning and the preparation for the transaction. So the due diligence and the understanding of how long it might take to realise disposal proceeds and what those disposal proceeds might be in terms of market value and transaction costs. And then post-transaction, provide a framework to actually implement that disposal and to try to do that within the guidelines and within the framework that we set for the pricing of the transaction originally.
I think that's a really important point, and I think that really enabled us to provide sort of the best value to the scheme because of those capabilities. We were able to be quite sharp in the pricing of the risk and the transition of these assets. So yeah.
Mm-hmm.
Yeah, it sounds like it was a big collaboration between sort of the insurer, the scheme, the asset managers. I guess that's one example of a scheme where this has worked. Jon, do you have any other examples of where we've worked closely with schemes and have been able to provide sort of illiquid solutions?
Yeah, I mean, I think we've worked on a few different scenarios and clients over the years, and I suppose one that comes to mind is trying to find one with a slightly different kind of scenario, but this one still a very large scheme. It had been toying with the idea of a transaction over time. It had engaged us to provide some pricing, and they saw that there was an opportunity to crystallise a surplus at some point, so they wanted to preserve that surplus. However, again, they had a portfolio of illiquids that they needed to try and transfer, dispose of, but retain that value so that the funding level and the surplus was preserved. And again, it was another healthy collaboration with Elgin.
Great. And I guess where clients aren't fully funded, is there anything we could do for them? Matt?
Well, our preparation is key. When time's on your side and you can plan ahead, it's very much like the four buckets that Sumit described earlier. Is what we're seeing clients doing is to think ahead and think, well, which assets can I transfer to an insurer? Which assets are going to run off with a natural redemption over time? They come to maturity, they pay their cash flows back out. Which assets could I sell, but may require me to put a subscription and redemption orders into advance and think about that? And then what's left? What are the illiquid assets that we know have to be sold at some point? And the balancing challenge that clients have is that these are good assets. They want the assets in their portfolio. They don't want to take haircuts on them, but they would take the haircut if they're also going to execute the transaction at the same time. And really the challenge is how you get both those two things to work together. So what we're seeing in our pension client book is increasingly clients thinking about, well, I'd like to get to this restructured portfolio of broadly credit and LDI that's ready for buyout. I've got time to do it. So what we'd like to do is to try and reshape and restructure those illiquid asset portfolios in the way I described. And as the cash flows come through, tip those into the credit portfolio and build a risk-adjusted portfolio that's ready for buyout. And to do that, we're using the same team, the same expertise that we use when we're doing that with Legal & General to help them on their PLT business.
Great. It sounds like communicating and just sort of preparing a little bit ahead, and will help facilitate a transaction at the end. And schemes with illiquid asset holdings, how would you say they need to prepare for a buyout?
I think reflecting on our experience, the earlier the engagement with the insurers, the better, because what we found out is that obviously there's a great deal of information that's required to analyze these holdings, but also that information is not readily available on the scheme side. So the groundwork in terms of getting that key information ready and sort of shared with insurers, that's very important. And to help enable that, we've worked hard to sort of create templates that we should share with consultants and schemes, so that we're only focusing on the key bits. And I think that has real value. And we find sometimes that schemes are reluctant to do that because they're sensitive about information sharing. And my personal opinion is that the benefits far outweigh the risks. I think as Legal & General, we are very, very sensitive to that risk, and we treat that very carefully. We will never share any client information with any third party unless there's explicit consent of the schemes. So that would be my main element. And I think having those client objectives clear is quite important. Jon,
yeah.
what are your thoughts on that?
Yeah, I mean, I think you're absolutely right. It's all about preparation. I think at some point the joint working group has to reach a decision point, and having all that information clear helps them form their objectives and how it fits in with the broader endgame planning. The rest of the deal is quite multifaceted, so all of this touches other arms of the benefits and the data and the transfer. So understanding the art of the possible, what is a good solution, what is the optimal solution, helps clarify those objectives and moves the deal forward.
Great, thanks. And I guess although illiquids are challenges, it sounds like through the deals we've done, we've got the experience and we've definitely got the expertise sitting in this room and the team behind them. If there was one sort of innovation you'd like to see in the market, what would it be? Jon, would you like to go first?
Thank you, Roshni. Yep. Sure. I think what you can see in the market is defined contribution schemes are investing more and more in illiquids. And you can also see the defined benefit schemes are looking for to transfer their illiquids where they can't transfer them to an insurer. So you would hope that there could be a way whereby the good assets, the good investments, can stay within the pensions landscape, but somehow transfer from the sort of maturing DB world into the DC world.
Is this similar to the master trust that we offer?
So that's exactly right. It's sort of facilitating the transfer. Obviously, there's good governance, there's pricing, what are the investments actually doing. But in principle, if you can build that platform, then it gives another investor that's interested in taking these assets.
Great, thanks. And Sumit, what innovation would you like to see?
Well, I'll revert back to my first opening comment that, we have this interesting dynamic, and it's an opportunity where insurers are looking for assets and pension schemes are sort of transitioning out of these assets. So I'm most interested in clever, innovative ways we can transform these assets into the right shape that fit the insurer's regulatory framework and risk appetite. And so we're looking at a few of these solutions, working with some external parties. So watch this space.
Okay. And Matt?
So for the assets that are left, the ones that need to be sold, then what we need is a wider market, more information around sale opportunities, so that the discounts that may be applying to those assets are reduced through competition. So we're looking at further establishing the market in secondaries beyond private equity into other asset classes, and then particularly for smaller schemes, finding solutions that can address a whole of portfolio problem.
Great, thanks. It sounds like a lot of input from the scheme and the insurer and the asset manager will lead to successful transactions even where there are illiquid complexities. But yeah, and I guess that kind of brings us to a close, and I'd like to thank you all for being here, and I'd like to thank you for listening in. I'm Roshi, and this is the PRT Pod.